Yeah, that's the intellectual challenge of a bull market. You don't want to be round tripped, but you don't want to miss the parabolic run at the end. And you've got to figure out how to set things up so that you've got a reasonable chance of being okay in either scenario. And like I said, I sold some physical silver. And you can also write covered calls on silver mining stocks. Don't go overboard with it because that's the same thing as selling a bunch of your silver mining stocks if all of them go up a little bit and then get assigned. But it's still a way to protect yourself a little bit. Central bank buying is still the steady driver of increases in the price of gold because the world's central banks, especially the BRICS country central banks, are not price sensitive. It's at the risk of oversimplifying, if you're the head of the Chinese central bank, you've been ordered by your dictator to accumulate X number of tons of gold. And you're not going to disappoint him. So the price bouncing around isn't going to affect your buying because you've got a target of X, meeting that target rate in a given time frame. So you're buying steadily at a rate that puts you where you need to be so you don't get murdered by your government. And that's what a lot of central banks are thinking about right now. They're not thinking, oh, let me get a good deal on this by putting a low ball bid in. They're thinking, okay, I've been ordered to accumulate this many tons and I'm just going to do it. I'm just going to steadily do it and I'm going to meet that target. And so that is a big reason why gold has been going up steadily. Like we haven't had a big crash in the gold price, which, it blew through to $2,000 an ounce US. Then it blew through $3,000 an ounce, consolidated a little bit there, blew through $4,000 an ounce, consolidated just a little bit, but not noticeably, really. And now we're halfway to $5,000 an ounce. And the reason for that is that these big whales out there that have printing presses that can generate as much new money as they need to are not done accumulating yet. Now, if oh, and by the way, China, it was announced, just bought $1 billion worth of gold off of Russia, which is a really interesting trade too. But it's completely possible that if central banks as a group decide to stop buying, then gold gets its big correction. But until that time, that's an awful lot of money on the buy side. And so I don't know any individuals. I haven't talked to anybody who's actually out there buying gold eagles or anything right now, just because they got crazy expensive. To the extent that retail people that I know are stacking, they're buying silver because silver, even though the gold to silver ratio has gone down lately. In other words, silver has risen relative to gold. Even though that's gotten closer to a reasonable level, silver still seems really cheap compared to gold. So yeah, you can pay, well, $75 an ounce. It's hard to even say that for an ounce of gold right now, and you can get, or an ounce of silver, sorry, and you can get quite a few ounces of silver for the price of an ounce of gold. And aesthetically speaking, that big pile of silver is just a lot prettier than that single gold coin. And so I think a lot of people are still doing that to the extent that they're buying at all. With silver, you've got the dual story of industrial metal and monetary metal. So as gold goes up, that naturally pulls silver up, so it can stay somewhere in the historical range of the gold silver ratio. But there's also all these new people coming into the market with solar panel makers buying huge amounts of silver all of a sudden. They weren't buying much of anything 5 years ago, and now they're the biggest single demander of silver. And now there are new solid state batteries coming along for electric cars that are much, much better. So we're told. They charge in no time at all. They go 600 miles, and they use silver, and they use quite a bit of silver.
As gold prices climb beyond the comfort zone of most individuals, retail investors are gravitating towards silver. While the gold-to-silver ratio has narrowed, silver still appears historically undervalued. Psychologically and practically, investors prefer accumulating multiple ounces of silver rather than a fraction of gold. Beyond affordability, silver offers something gold does not: a hybrid identity. It functions as both a monetary metal and a critical industrial input. This dual role gives silver a unique demand profile, linking it not only to financial stress, but also to technological growth and manufacturing trends worldwide.
So if they actually turn out to work, and Samsung, for instance, has scheduled the beginning of mass production for 2027, so it's not that far out. But if they become a thing, if that's the new way to power an electric car, then there's no silver left for anybody else. It's gonna that sector alone will pick up all the available extra silver that's sitting in warehouses right now. And so then we've got somebody else who's a buyer and who's not price sensitive because they have to do what they have to do. You gotta if you're Tesla, you got to produce 1 million cars, and if silver is a crucial part of the batteries that go in those cars, well, you're going to pay whatever you have to pay to get those cars out the door. And, it's like that for all the car makers out there. That's a gigantic market. And the numbers that are being tossed around right now is that each electric car using those new solid state batteries will need a kilo of silver. And so something like that makes everything else irrelevant, and it certainly doesn't rely on individual investors buying silver to make silver go up in price. So, I think that it's completely possible that silver has one of those runs that you just talk about for a century in the next few years. And monetary, it could happen just because of the currencies of the world having their waterfall declines, or it could happen because industrial technology is changing in a way that requires more silver, or it could happen from a combination of those two things. And if it's a combination of those two things, then I don't know what the upper limit is for silver. I think we see some triple digits for sure, but how far up into the triple digits is anybody's guess. And the only conclusion that you can come to is that you need to own some silver. That this is even possible, that we can even talk about this, means a share of your nest egg needs to be in physical silver and possibly silver mining stocks. So that's a whole investment thesis right there, how you use precious metals in all their forms to protect yourself from what's coming.
Silver's industrial role has expanded dramatically. Solar energy alone now consumes more silver than any other sector, a sharp shift from just a decade ago. Looking ahead, next-generation technologies could intensify this pressure. Solid-state batteries, expected to enter mass production later this decade, use substantial quantities of silver and promise major advances in electric vehicles. If adopted at scale, demand from this single industry could overwhelm existing supply. Unlike investors, manufacturers cannot delay purchases based on price. When silver becomes essential to production, demand becomes relentless and non-negotiable.
Well, I think the long-term thesis is intact. The story of silver is just great, and over the next decade, it's going to be an awesome thing to own. But boy, it blew through a lot of levels where there should have been some resistance. There's a saying that in a bull market, the hardest thing is to be patient. In other words, don't just get out of something right away because you doubled your money. Here I have a story about that. A little digression here. A while back, and I can't even remember what the company's name. Oh no, it was Glamis. There was a little gold miner named Glamis Gold that I bought like $10,000 worth of back when, and it doubled. So I sold out. I thought it was a genius. And in the ensuing year, I watched that thing go from $1.50 a share to $50 a share. So all I had to do was go to the beach for a year, and I would have had a net worth in the top 5% of Americans. And that's kind of what might be the case with silver now. It's had a nice run, but the upside is so outrageous that you wouldn't want to get out of everything now. But I actually sold some silver just this week. I sold some ounces of silver in a gold money account in London, just to be on the safe side. When you're fully invested in something and it has a great run, there's no problem with taking a little bit of it off the table. but you don't want to take all of it off the table because, if you've spent a lot of time, like you and I have with silver, we've been watching this market forever and we've made our bets and everything. And the last thing you want is to get out prematurely and then miss that big parabolic run. That kind of means all your time over the past decade was wasted, right? Because you didn't stay for the finale. And so that's the tricky thing now with something like silver is obviously you don't want to be round tripped. And a round trip to say 30-ish is completely possible if we have that recession and equities bear market and they throw all the babies out with the bathwater and gold and silver are among the babies and they tank. That's a completely believable scenario.
Silver markets are thin, volatile, and vulnerable to shocks. Warehouse inventories are limited, mine supply growth is constrained, and years of underinvestment have reduced flexibility. In this environment, prices can move violently in both directions. That volatility is the cost of admission for extraordinary upside. If monetary instability converges with industrial shortages, silver could experience a once-in-a-generation repricing. While pullbacks remain possible, even likely, the long-term asymmetry favors higher prices. Silver doesn't require widespread retail participation to rise. It only needs structural scarcity combined with mandatory demand.
And you really don't want to be, if you have to ride it all the way down and then ride it all the way back up, you still end up being fine. But it's emotionally exhausting. It's horrifying to be round tripped in a big position. So that's the tricky thing now. How do you structure your money and your investments so that you're reasonably protected from a V-bottom crash, which we could easily see, but you're still exposed to something like silver for the long haul. And there's no one right answer. You take a little bit off the table. So you have some cash. So in case there's that V-bottom crash sometime in the future, you're able to console yourself that, yeah, your existing silver went down, but now you can buy a bunch more and have another chance at a 10-bagger run going forward. And yeah, like Warren Buffett is doing now. He thinks U.S. stocks are bullish in the long term, that the U.S. economy is going to be great. The stock market will be a very successful place to have your money, but he's raising more cash than he's ever raised in his life because he doesn't see bargains out there anymore. And so he expects to hold that cash until the stocks he likes, the companies he likes, till their stocks drop to a reasonable level. So yeah, that's the intellectual challenge of a bull market. You don't want to be round tripped, but you don't want to miss the parabolic run at the end. And you've got to figure out how to set things up so that, you've got a reasonable chance of being okay in either scenario. And like I said, I sold some physical silver. And you can also write covered calls on silver mining stocks. Don't go overboard with it because that's the same thing as selling a bunch of your silver mining stocks if all of them go up a little bit and then get assigned. But it's still a way to protect yourself a little bit. You get some cash back when you sell a covered call, and that cushions part of a drop should that happen in the future. So yeah, there's a lot to do. And in my Substack newsletter, that's one of the topics that we talk about a lot there is, how do you manage this as we go? We know the long-term story, but how do you manage the squiggles? And should you manage the squiggles? What can you do?
One of the hardest challenges in a bull market is patience. Investors often exit winning positions too early, locking in modest gains while missing life-changing moves. History is filled with examples where assets multiplied many times after early sellers stepped aside. Silver presents a similar dilemma today. While prudent investors may trim positions to manage risk or raise liquidity, abandoning exposure entirely risks missing the most powerful phase of the cycle. The goal is balance, staying invested while protecting against extreme downside without forfeiting long-term opportunity.
Well, you protect yourself against a big drop in the broad stock markets by hedging a little bit. You can buy 2-year put options, as I mentioned before, on the NASDAQ or something like that. And that gives you a little bit of insurance against a dramatic stock market decline. And, you can raise some cash. It's okay to have cash. And you put it in something like a short-term treasury fund where you earn 3% interest or something like that on it. So you get some return while you're waiting. And, there's very little risk in a treasury paper fund because the government can always pay you. They can always print the money that they need to pay the interest on that paper. And you can always get out. If you've got like Charles Schwab has a treasury bill ETF that you can sell like a stock. So you can get out instantly if you need to. But in the meantime, it's a way of parking cash, and you can do something like that. And within the commodities complex, which I think is still the best place to be right now, even though they've had some nice runs, there are still some undervalued sections of that complex, like oil, for instance, has gone down while everything else is going up. And the dynamic in the oil industry is pretty bearish because we're producing an awful lot of oil and natural gas around the world, and they're cyclical. So if we have a recession, people drive less, the price of oil goes down, that hurts the earnings of the oil companies. But the biggest high quality oil companies will still be okay. Exxon has raised its dividend for something like 50 years, straight through all the recessions and near depressions and everything that we've had. And so something like that is, it's not sexy. They're not going to quadruple or anything, but they're reasonably safe because they pay decent dividends, and that protects you from just a crash. So something like that is something you can do too. And if you're not already involved in real estate,
managing capital in this environment requires flexibility, not conviction alone. Holding some cash, using conservative hedges, or selectively diversifying into defensive assets can reduce emotional and financial strain during drawdowns. Cash itself is not idle if deployed intelligently through short-term instruments. Meanwhile, within commodities, not all sectors move together. Energy, metals, and materials follow different cycles. Silver remains compelling, but discipline matters. The long-term thesis is intact, yet the path will be uneven. Success will favor investors who prepare for volatility without losing sight of the destination.